Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to cover two big requests that I've had for a lot this week, but even before that. Hims and Hers Health, ticker HIMS, and Novo Nordisk, ticker NVO in the US. I think it might have the same ticker over in Europe too. So both healthcare drug companies, quite different types of businesses, but they've been in the news recently because they had an agreement that they agreed to a few months ago for Novo to sell its weight loss drugs on the Hims platform and subscription model that was called off. I don't know. I think it was this week. So a lot of volatility from the stocks after that, and a lot of questions among folks. As always, this is not individual investing advice, just how I analyze stocks. I'm going to give you kind of the strategy I would use for these stocks. I'm actually long both of these. Both have been weekly picks in my weekly picks service over on Patreon. That's $25 a month if anyone's interested. And then I owned Hims even before I started that service over on Seeking Alpha at the Cyclical Investors Club, and it's up about a couple 100%, I think, now since we originally bought it. So I own a lot more Hims than Novo, which is good, I guess right now. Okay, so what I'm going to do here is use a time until payback method. So what I do is I look at the earnings of the businesses and the earnings growth trajectories and expectations. And then I model out how long it would take you to earn back your investment in one of the businesses from earnings. So if you bought one of the businesses for $100, how long would it take for you to earn $100 back from the earnings of the business? And I'm going to use a couple different methods here. That's the main one, but a couple different techniques, I guess I'd call it, especially with Hims. But maybe we'll start with, I can do them both together, but let me start with Novo, and we'll go from there. Now, before I get started, I want to say that, so this breakup was a little bit weird. Also newsworthy, Novo fired their CEO. Which the reason given was because of the stock price performance. All right. So if we look at from the peak to whenever that, I don't know exactly when that happened. It wasn't very long ago. We're talking like weeks. So the stock is down like 50%. But if you go back just a couple years, it's up over 100. And from back here, when you think of all the development and stuff that was going on, it's up a couple 100%. So you should never basically fire a CEO for stock price performance. And I don't know if that's the real reason, but the fact that they would even put that out in public and say it, and the reason for that is the stock price can do a lot of crazy things that is not part of the fundamentals of the business. So sure, the stock price fell a lot, but at the peak, it had been up 200% in a year and a half or something like that. So and earnings have risen every single year. Even last year, they rose 14%. So earnings are growing fine. The market can do whatever it wants with the stock price. It can do crazy things. Was it ever worth 48 PE? No. So the market mispriced it then. If you just go back to one of these other peaks, it only had a 23 PE. So that's not even picking like a bottom. So that's probably close to a normal PE ratio for the business. And when it trades at more than double that, it should fall 50%, okay, or something along those lines. So maybe there was other stuff going on. It's hard to say. The CEO didn't strike me as unusual or bad or anything like that. So I mostly question the insiders that own the majority of the family that owns the majority shares. And I question the pressure had to come from them, if you ask me. And if they freaked out because the stock had fallen 40%, that doesn't give me a lot of confidence that they know what they're doing. I mean, so even though I'm still long the stock, I'm less bullish, I think, than I was before, because it questions whether they can manage going forward. And so I thought the deal with Hims that they had, being long both the stocks when it was announced, was a win-win situation. And the market thought so too, because it sold both stocks off when the news was announced. So most of the people that are paying attention thought it was a good deal, and Novo decided to back out. Now, they can have other reasons than the ones that are stated, and I don't know all the inside information. And it's probably annoying when a company is selling a compounded version of the drug you're trying to make a bunch of money on, and undermining your price, right? So I get a little bit of the frustration. But it's, either don't give a reason or whatever, but don't give a stupid reason, if it's not true, for firing your CEO and then cutting a deal off that everybody else thought was pretty good. So those are just my broader feelings and context from someone who's long both the stock. Okay. Now, valuation wise, if we look, we can see that they're expected to earn $4.02 this year, but then analysts are looking at like mid-teens earnings growth for the next couple of years. So I'm not sure and the fast graph comes in at about 15.13 during this entire period. I'm going to assume that they hit their earnings this year and that they can grow 15% each year after that, which is pretty optimistic, but directly in line with what they've done and directly in line with what analysts think they're going to do at least the next couple of years, okay? So that's how I'm going to approach this, and then I'll run the numbers here at the same time that I do Hims. So let's go back to Hims, and it's going to be done slightly differently. So for Hims, because they're expected to grow earnings so fast the next couple of years, usually I limit my earnings growth expectations to 20% 20% per year over the long term. I never go higher than that, because it's very hard to grow more than 20% for a long time. But a business can definitely grow 40%, 39%, and then maybe that slowly declines over time or quickly declines and levels off or something like that. But they're not going to grow 40% a year forever. I don't know what the PE is right now. 78. It's pretty big. And I think it's up again today. So what I want to do is kind of use a mixture of those methods. I want to keep my 20% limitation, but I'll give credit for the next couple of years that they can grow faster than that. What are they? They're a $10 billion company, so they're not super huge. So let's say that they do what analysts think. They grow. They hit their 65 cents this year, and then they grow this fast. So they're going to earn $1.28 in 2027. So what I'll do is, because I'm measuring how long it will take to get paid back, I will assume that they hit this here, and they can grow 20% a year after that. Okay? So maybe they'll grow faster than that. That happens sometimes. Maybe this year will be 60%, and this year 50%, and the next year 30% or something. Don't know. These are just estimates to try to get a ballpark of what's a reasonable price to pay. Because what can happen with these stocks is, well, you can see how volatile they can get, and it can be hard to determine what's a reasonable price to pay when earnings are growing really fast. And sometimes the market can get kind of carried away. And if they slow down after that, then you can lose a lot of money. So you want to buy when the valuation is like reasonable. So what I'm going to do is I'm going to go forward 2 years and use their earnings, but whatever the time until payback, however many years it would take to earn your money back from that point, I'll add 2 years to it to account for these 2 years that I'm skipping forward. Okay. So we're going to add 2 years to this one, because shorter is better. Right, the faster you can earn your money back, the better it is. And usually, like, I want it to be under 10 years or around 10 years to be like a buy. So let's go look at these two together using the same method. The only exception is I'm going those 2 years forward on Hims, and And really, I'm giving Novo 15% earnings growth, which is what they're expected to basically grow the next couple of years. So it's really the same, but I'm using this year's earnings for Novo and earnings 2.5 years forward for HIMS. So when you do that, and I'm assuming that Novo grows 15% after that, and that HIMS grows 20% a year after that. So when we think about this, if you paid $100 for Novo's business, you would earn $5.86 plus I pull forward the 15% growth. So it'd be a little bit more than that. So you can see that Novo is going to start from a higher base of earnings, but it's going to grow at a slower rate. Whereas HIMS, because of the valuation, you would only earn $2.59 plus 20% growth the first year, and then it grows at 20% after that. So you can kind of, using this method, you can compare the two businesses together and kind of see how the valuations are work out compared to each other by how long it would take to get paid back, even though the valuations are quite different. So the starting valuations, I should say, which is the PE ratio. But you have to take into account growth and time as well. So let's see here. So the first year, if you bought HIM stock for $100, bought the whole business, you could earn $3.13 that year. And with Novo, you would earn $6.75, right? And you could keep that if you own the business. I don't assume that share buybacks and dividends and all that comes out of this if it ever decides to get paid. So we don't need to concern ourselves too much with that. But we want to see how long it would take if we collected all this money to get up to $100. Now, just out of curiosity, we can see at what point they will cross, at what year they would cross and be earning the same amount. It looks like about year 18, HIMS would catch up, which would really be, but you'd have to add 2 years for like year 20, so it would be more like that. But then after that, the HIMS you could collect more and more money on it because it's growing at a faster rate. Now, this is getting way far out in the future. I don't project usually that far out in the future. Well, I do for valuation purposes here, but neither one of those you need to go out that far. So with Novo, which looks reasonably cheap here, it'd only take 9 years. So that looks like a pretty good valuation as long as they can grow earnings 15% a year. If they can hit that, that looks really good. HIMS, on the other hand, would take 11 years, which is more than the kind of under 10 that I would like, 10 to 9. However, we need to add that extra 2 years to it. So it actually takes 13 years. So HIMS is more overvalued right now than Novo, in my opinion, or using these assumptions. So the question is, should a person buy Novo? Now, I think, in order to, this will switch from 9 to 10 at about $77 per share. Right now and I did not make any adjustments for debt for these companies. Right now it's trading at like $68 per share. But let's go back to the fast graph here. But given the recent developments, we can see that it does look like it's kind of putting in a potential bottom here. It's trying to, but it's free falling all the way down to where it's at now. And usually when that happens, what I want to know is often, now I bought a little bit on the way down, but just a small position. I want to see momentum be positive and for there to be a more optimistic outlook on whether they'll really hit these earnings, because even just the next couple of years, part of the issue is they have a lot of competition that's coming really quickly. So if they don't make the proper adjustments, they might not be able to grow earnings at this rate, and that's what the risk the market's pricing in, basically. So sometimes when the stock will fall because the market sees that earnings will fall, and then later we get the report that the earnings fall. And we want to be a little bit careful about going all in on what is a falling knife. Now, I do think the valuation is looking probably good enough for a starter position right now. But I wouldn't be adding until momentum for the stock got better too. So, and usually I use Seeking Alpha's momentum factor for this, but you can use just a 200-day moving average. So to get like actually bullish on it, this is where it stands right now. So it's at about $90. The stock's trading at 68. The threshold above which it would no longer be a buy is 77. So really what you want to happen is to have this simple moving average get down close to that $77 spot. And then you want the stock price to rise above the $77 or rise above the simple moving average, preferably while it's below $77. So when those metrics all kind of come together, potentially they might not. If the stock free falls or whatever, then it will never cross this, and so you wouldn't want to add any more to it. If it did it right now, if the stock rocketed higher and it went up to $95 or something, that would probably not be a good valuation unless the earnings situation forecast changed. So I wouldn't go all in on this drop, but the valuation does look reasonable if they end up hitting those numbers. But there's some questions whether they're going to be able to do that. So that's why ultimately you want to be cautious. And I don't think anybody really knows what's going to happen here because there's so many moving parts, so many new drugs and competition coming from all over the place that, you know, they might not be able to grow 15%. On the other hand, I think the weight loss drugs are pretty much game changers as far as we can tell right now. And it could be a secular growth thing that lasts quite a while. So having some exposure to that is probably a good idea as long as it's a reasonable valuation, which it is right now. So to sum up, a little bit, which by a little bit is like 0.5% of portfolio, which is what I have, although that's fallen. I bought like 20% higher, is probably okay because we don't know exactly. The valuation looks pretty good so far, but before adding to it, you want the technicals to look better, and for there to be some more confidence in the earnings forecast. Now with HIMS, sort of the same thing, but I think $25 is where I would probably buy on the way down. It actually crossed that earlier this year on the way down. I forget the date that I added it. I think we added it back last year when it was probably down. I've bought it a couple different times. So, and it's been extremely volatile. You just have to learn to like do nothing, right? When it gets kind of this volatile, because it's overvalued right now. But for my growth strategies, once I'm in, I'm looking 10 years into the future with these. So you kind of just have to be happy, I guess, but not too happy when it spikes up like 300%, and just realize that's probably not going to last. But just because it doesn't mean it's going to fall to like a buyable level. I think this probably was right here. Like 25 is roughly that buy on the way down level. Otherwise, let's go back to the spreadsheet because I think I put notes in here. Otherwise, I think we're looking at, so similar situation. If it fell below 38, but it had positive momentum, so if it had one of these crashes that we've seen it happen a lot, but maybe it falls to $28 and then it starts to come back up and it crosses that, we'll just use the 200-day moving average. And then it's still below $38, then I think that's when you add. That's a situation where you add. Because you're getting a reasonable valuation. That $38 is a 12-year time until payback. That's the most I would pay for anything, basically. So if you can stay below that on a fast growth stock with good momentum, then, there's a little, it's not perfect. I mean, it's always best if you can get it when it's cheap, which fortunately we were able to do a while back. But it's been cheap it's gotten down there every now and then. So, and it can make wild swings, so you think it's not going to, how much did it fall here? So like 60% in how long? Like a month, something like that. So you have to be willing to put up, and then it fell 30% in a day right here, or maybe 35%. It was kind of crazy. But you can kind of see the lower baseline of the stock, the lows are making higher lows. So the trend is kind of in the right direction. And if you can get at least a little bit on the way down when the valuation looks good, and then potentially a little bit more. Now, when it jumps this fast, usually you don't have enough time to buy, when the momentum looks better. But we don't know how the future is kind of going to shake up. I expect volatility to be pretty high still. So I don't get too excited right now when it's up 200%, I think is kind of where the initial position we had is up. And then the weekly picks one is up over 100% too from last fall or winter. But I mean, I just kind of take the ups with a grain of salt too, because they can fall, they can be cut in half pretty quickly. And it's just a matter of, you kind of placed your bet. Now just hold on to it and see what happens. And if the growth works out, it will work out. And if it doesn't, then it won't. And that's just how, and then you find, hopefully you make enough good investments to make up for the ones that don't work out. But they can be big winners, right? You only need a couple big winners, like really big winners, which this one could potentially be 10 years from now, to, make up for the ones that don't work out. Okay, so hopefully you guys found that useful with two stocks that I have bought that are, neither one of them are really in my wheelhouse. Him's a little bit more because it's a growth business. It's not a drug maker it's more of like a subscription model and delivery system and advertising, with a lot of advertising. So that's a little bit, I can understand that and predict that maybe a little bit more than what's the next blockbuster drug going to be. But you can still kind of try to put some useful numbers on it to make sense of this app, just craziness. Like, stocks really shouldn't do what this stock has been doing. And there are other stocks in the market like that too. And it was just luck that I happened to have one that jumps up to 200% in a month or something like that. But I don't take any more credit for that than I do the ones that are only up 20% if it's justified, because it's overvalued right now. Okay, if you found this useful, hit the like and subscribe button. I have a free tier on Patreon where I post a lot of valuations, and I post a lot here on YouTube as well. Check out that weekly picks service over on Patreon as well. That's $25 a month. I'll see everybody later.